Should you invest your money in stock market or buy a rental property? Today I will break it down into simple terms so that you would know how you can maximize your wealth either by investing in stock market or buying a rental property. A lot of people think property is always better. Others think stock always win. But the truth is, both make money but in completely different ways. Let's start with stocks. Stocks are usually easiest way to start investing. You don't need a large amount of money, even $50 or $100 is enough. The process is completely simple and passive. Passive means you are not investing a lot of time or effort on daily basis. In long term, stock market has delivered 7 to 10% average annual return, especially if you invest in broad index funds like S&P 500. You do not need to invest in individual companies. You simply invest regularly and let the market grow over time. Investing is very accessible worldwide. In Canada, Wealthsimple has made it simple and easy for beginners. In United States, platforms such as Fidelity and Vanguard is very common. And in Europe, platforms such as Trading 212, DeGiro and Revolut are very popular. And in Australia, platforms such as Comsac and Self-Wealth most investors use. Idea is same wherever you are. Buy low-cost index funds and hold them for a longer period of time. Of course, stocks have their own pros and cons. Pros: low cost to start, completely passive, you can buy and sell anytime, and strong long-term growth. Cons: prices move daily. There is no fixed monthly income like rental, and many beginners sell stocks during drop, like recent announcement of US tariff in 2025. You do not need to panic and sell everything unless you understand the facts and have experience. Property. Now let's look at the property that you own and is rented out. It is a bit complicated and requires extra work, but powerful because of its leverage. Rental properties or the property that you own usually grow 3 to 5% each year depending on the location. But the main thing is this growth is on the entire home value, not just your down payment. For example, if you buy a property for $500,000 and it grows 4%, it means you make $20,000, not on your down payment, but on the entire property value. And usually your tenant's rent pays your mortgage, property taxes, and utilities. A lot of people get confused at this point. They say, if the interest rate is 4.75% and the property is only growing by 3 to 5%, how does this even make money? My explanation is your property growth of 3 to 5% is on entire property value, and your 4.75% interest rate is only on your mortgage portion. Even though if you are at break even, your property is still building your wealth because your property is keep increasing in value over time and your tenant is paying down your mortgage. When you add all this together, a break-even rental can still increase your net worth by $25,000 to $30,000 each year without you making any profit each month. And when your house is paid off, every month you will still be earning rental income along with increase in your property value over time. So now the main question is, which one gives higher return? For beginners, stocks are safer and gives higher return, especially index funds. But if you use leverage properly, real estate can beat stock because you are building big asset with small down payment. Investing in index fund is passive and simple. In contrast, property requires extra work, but in long term, you are building your wealth through appreciation, mortgage pay down, and rental income. In conclusion, there is no right answer. But if you want something simple and hands-off, invest in index fund stocks. But if you want to build your long-term wealth and you don't mind some hassle, property works too. The best thing is to do both when you can. If you enjoyed this video, please like and subscribe for more useful content.